if I showed you two charts right now, without labels, without dates, and without context, you would tell me they are the same chart. You would see the same jagged ascent, the same volatility, the same minor corrections, and the same explosive vertical growth at the very end. You would trace the lines with your finger and conclude that they represent the same asset, the same market, and the same psychological pattern. But if I told you that one of those charts represents the S&P 500 today, and the other represents the Dow Jones Industrial Average in 1929, right before the greatest economic collapse in human history, you might stop listening. You might call it fear-mongering. You might say things are different now. You might say we have the Federal Reserve. We have technology. We have safeguards that didn't exist 100 years ago. And you would be repeating, word for word, exactly what they said in September 1929. There is a mathematical heartbeat to the financial markets that most people never see because it beats too slowly for a human lifetime to notice. We are conditioned to think in quarters, in fiscal years, maybe in election cycles. But the market doesn't operate on human time. It operates on a cycle that spans generations, a cycle that resets specifically when the last generation that remembers the pain of the previous collapse has finally died off. That cycle is 88 years. And right now, the mathematics of 1929 are overlaying the mathematics of the 2020s with a precision that is not just eerie, it is terrifying. We are not just due for a correction. We are mathematically locked into a collapse that will make 2008 look like a gentle warm-up. To understand why 2027 is the terminal date for this economy, you have to understand what actually happened in 1929. History books will tell you stocks crashed and the Great Depression started. But they don't tell you about the psychology that led to it. They don't tell you about the new era narrative. In the 1920s, a new technology had emerged that revolutionized everything. It connected the world instantly, it allowed for mass communication, and it created a level of productivity the world had never seen. That technology was the radio. Along with the automobile and the electrification of factories, it convinced every economist, every banker, and every shoeshine boy that the old rules of economics no longer applied. They believed they had unlocked a perpetual growth machine. Does that sound familiar? Replace radio with internet. Replace electrification with artificial intelligence. Replace the automobile with EVs and autonomous driving. The narrative is identical. In 1929, investors were pouring money into RCA, the Radio Corporation of America, driving its stock price to astronomical levels that had no basis in earnings, purely because radio was the future. Today, trillions of dollars are flooding into NVIDIA and the tech sector because AI is the future. And they are right. Radio was the future. AI is the future. But being right about the future didn't save RCA investors from losing 97% of their money when the bubble burst. Being right about the technology doesn't protect you from the mathematics of overvaluation. The 88-year cycle is not about astrology. It is about the constraints of human nature. Fear and greed are biological constants. They do not change. Because human biology doesn't change, the way humans speculate in crowds doesn't change. When you map the crowd behavior of the Roaring '20s against the post-COVID boom of the 2020s, the algorithm is identical. Let's look at the setup. The 1920s boom was fueled by the newly created Federal Reserve keeping interest rates artificially low for too long, flooding the system with easy money to help Britain return to the gold standard. This easy money found its way into the stock market. Now look at 2020. The Federal Reserve printed more money in 24 months than it had in the previous century combined. They flooded the system with liquidity to combat the pandemic. That money didn't go into the real economy. It went into assets. It went into the stock market. The catalyst is exactly the same. An unprecedented injection of liquidity by a central bank that believes it can control the consequences. But here is where the math gets truly frightening. It's the retail trap. In 1928 and 1929, the stock market ceased to be a place for professional investment and became a national casino. Regular people, factory workers, maids, bellhops, were taking out loans to buy stocks. They were buying on margin, putting down 10% cash and borrowing 90% from the broker. They were leveraged 10 to 1. They believed stocks only went up. Today we have the exact same phenomenon, but we call it something different. We call it 0 DTE options. We call it Robinhood margin accounts. We call it We call it Reddit communities pumping meme stocks. The leverage today isn't just 10 to 1. With derivatives, it is often 100 to 1. The exposure of the common citizen to the financial markets is higher now than at any point since 1929. The public is all in. And the pattern dictates that the market crushes the public only when they are fully invested. So where are we in the cycle? If you overlay the Dow Jones chart from 1920 to 1929 over the S&P 500 chart from 2014 to 2024, the correlation coefficient is nearly perfect. We have passed the initial boom. We have passed the first warning sign. The volatility of 2022 was the equivalent of the volatility of 1928. We are now in the most dangerous phase of the cycle, the melt-up. Most people assume a crash happens when things look bad. That is incorrect. A real structural collapse happens when things look their absolute best. In the summer of 1929, the market went vertical. It accelerated. Gains that used to take years were happening in weeks. The skepticism vanished. The bears, the people betting against the market, were bankrupt or converted. This is called the blow-off top. It is the final suck-in phase designed to pull the last dollar of savings from the sidelines into the market. We are seeing that right now. The market is ignoring interest rates. It is ignoring war in the Middle East. It is ignoring war in Europe. It is ignoring $36 trillion in U.S. debt. It keeps going up. This resilience is not a sign of strength. It is a sign of a terminal mania. The famous economist Irving Fisher stood up in October 1929, just days before the crash, and proclaimed that stock prices have reached what looks like a permanently high plateau. He wasn't stupid. He was looking at the data, and the data showed an economy that was unstoppable. He was blinded by the new era narrative. Today, we hear the exact same quotes from Wall Street analysts. They tell us that AI will increase GDP by 10% annually forever. They tell us that recessions are a thing of the past because the Fed knows how to manage the soft landing. They are reading from Irving Fisher's script, and they don't even know it. The math of the 88-year cycle points to a specific window for the turn. The cycle suggests that the peak of the mania occurs roughly 9 to 10 years after the previous major structural low or pivot. But the more precise alignment is the time to crash ratio. The expansion phase of the 1920s lasted roughly 8 years from the 1921 depression bottom to the 1929 top. The current expansion, if we measure from the distinct structural shift of 2016 or the deep liquidity pivot of 2018, targets late 2026 to early 2027 as the mathematical limit of the bubble. This is when the melt-up exhausts itself. It is when the last buyer has bought. But why 2027? Why not next week? Because a bubble requires a specific psychological trigger to burst. In 1929, it wasn't just one thing. It was a combination of liquidity drying up and the realization that the consumer was tapped out. The Federal Reserve had begun raising rates in 1928 to cool the speculation, but the lag effect took 18 months to hit the economy. We are in that lag period right now. The Fed hiked rates aggressively from 2022 to 2023. Everyone is celebrating that the economy didn't crash immediately. They think we escaped. But in 1929, the economy didn't crash immediately either. The market kept rallying for a year after the tightening began. The lag effect is real. The debt wall, trillions of dollars in corporate and government debt that needs to be refinanced at these higher rates, hits specifically in 2025 and 2026. By 2027, the math of interest payments overwhelms the math of revenue. When the crash comes, it will not be a slow decline. The 1929 pattern shows that when the psychology breaks, it breaks all at once. It is a vacuum of liquidity. In 1929, there were no buyers. You called your broker to sell, and he told you there was no bid. The price wasn't lower, the price didn't exist. In the modern era of algorithmic trading, this will happen in milliseconds. It's called a flash crash, but one that doesn't bounce back. Imagine opening your brokerage app and seeing Apple down 40% in pre-market, and the sell button is grayed out because trading has been halted. Imagine checking your 401k and seeing that a decade of gains has evaporated in 3 days. The 1929 crash was an 89% drop from top to bottom. Let that sink in. An 89% drop today would take the S&P 500 down to levels not seen since the 1990s. It would wipe out every retirement account in America. It would bankrupt pension funds. It would dissolve the solvency of the banking system. But the Fed won't let that happen. you say. They will print money. This is the final trap of the 1929 parallel. In 1929, they tried to stimulate, but they were constrained by gold. Today, they are constrained by inflation. If the Fed prints trillions to save the market in 2027, they will trigger hyperinflation. If they don't print, they trigger a deflationary depression. They are trapped. The cycle has cornered them. This is why the 88-year cycle is often called the sovereign debt cycle. It is the point where the debt burden becomes so large that the currency itself is the victim. The parallels extend beyond the charts. Look at the wealth inequality. In 1929, the top 0.1% owned as much wealth as the bottom 90%. Today, the numbers are nearly identical. This concentration of wealth creates a fragile market because the smart money is a very small group of people. When they decide to exit, the door is very small. In the weeks leading up to the 1929 crash, the insiders, the Kennedys, the Rockefellers, were quietly exiting the market. They were converting stocks into gold and cash. They were giving public interviews saying the market was strong while privately selling everything. We are seeing the same behavior today. Look at the insider selling ratios in the Magnificent Seven tech stocks. The CEOs and founders are selling billions of dollars of their own stock while telling you to buy. Zuckerberg, Bezos, the heirs of the new economy, they are cashing out at the top. They know the cycle. They have the best data in the world. They can see the consumer spending slowing down in real time. They can see the credit card delinquencies rising. They know the soft landing is a lie told to keep the retail investor holding the bag while the institutional money escapes. The 1929 collapse didn't end in 1930. It started a decade of darkness. It changed the structure of society. It led to the rise of radical politics globally. It led to currency wars. It led eventually to World War II. The economic collapse is always just the precursor to the social collapse. We are already seeing the cracks in the social fabric. The polarization, the anger, the distrust in institutions. This is the pregame show. When the wealth evaporates, that anger will find a target. The cycle also tells us about the safe havens that aren't safe. In 1929, people thought corporate bonds were safe. They collapsed. They thought bank deposits were safe. They vanished. The only things that held value were assets outside the financial counterparty system: gold, land, and productive skills. Today, millions of investors believe they are diversified because they own an S&P 500 ETF and some bonds. In a systemic correlation event, which is what the 1929 pattern predicts, all financial assets go to one. Stocks, bonds, real estate, they all crash together because everyone is selling everything to raise cash. There is a concept in market geometry called symmetry. It suggests that the faster and steeper the rally, the faster and steeper the decline. The angle of ascent in the last 2 years is unsustainable. It defies the laws of economic gravity. We are pulling future growth into the present via debt. We are spending money from 2030 to feel rich in 2025. But eventually 2030 arrives, and the bill comes due. The 88-year cycle is simply the bill collector. You have to understand that this isn't a glitch in the system. It is the system. The system requires these purges to function. It requires the transfer of wealth from the impatient to the patient, from the leveraged to the liquid, from the ignorant to the informed. By keeping the masses distracted with political theater and new era tech narratives, the financial elite ensure that when the reset happens, they are the ones holding the hard assets, while the public is left holding worthless paper. The period we are entering, the window between now and 2027, is the distribution phase. This is where the smart money hands the heavy bags to the retail public. They create a FOMO, fear of missing out environment so intense that even the most prudent saver feels like an idiot for not being invested. You will see your neighbor getting rich on options. You will see news headlines about the Dow hitting 45,000, then 50,000. You will feel an overwhelming urge to join in. That urge is the signal. When the last skeptic capitulates and buys, the top is in. The crash of 1929 was not a single-day event. It was a process. It started with a slide in September, a bounce, and then Black Monday and Black Tuesday in October. But the real destruction happened over the next 3 years. The market ground down day after day, month after month until 1932. It didn't recover its 1929 peak until 1954, 25 years later. Imagine that. Imagine if the stock market crashes in 2027 and doesn't break even until 2052. Imagine what happens to your retirement plans. Imagine what happens to the social contract. The math of the 88-year cycle is shouting at us. The PE ratios are shouting. The debt to GDP levels are shouting. The divergence between the stock market and the real economy is the widest it has ever been. In 1929, they ignored the signals because they were making too much money to care. They were dancing on the deck of the Titanic, entranced by the music, ignoring the iceberg. Today, the music is louder than ever. The party is wilder than ever. But the iceberg is still there. We are not different. We are not smarter. We are just the next generation in the cycle, about to learn the same lesson our great-grandparents learned. The debt must be paid. The mean must be reverted. The bubble must burst. The cycle does not care about your hopes, your dreams, or your retirement account. It only cares about equilibrium. And after a decade of artificial suppression, the return to equilibrium will be violent. The window to prepare is closing. The melt-up gives you a chance to exit, a chance to secure tangible value, a chance to step off the tracks before the train arrives. But most people won't take it. Most people will ride the chart all the way up, cheering the whole way, and then ride it all the way down, wondering what went wrong. They will blame the politicians, they will blame the banks, they will blame bad luck. But the truth is written on the chart. It was always going to happen. The math matched exactly. 1929 was the warning. 2027 is the destination. The only question left is, will you be watching the collapse from the inside or from the outside?